So we'll now deal with depreciation and amortization here. Now, what are the points are going to be covered here? First of all, you have to understand the meaning of depreciation. Second one is reason for depreciation. Third one is why do we bother about calculation of depreciation? Means the objectives of depreciation. And after that, we have to find out the depreciation using some methods. You have to understand there are a number of methods available for calculating depreciation. So method of depreciation. After finding the depreciation amount using the applicable method, you have to account it. So accounting of depreciation. These are the 5 predominant aspects you have to cover. And after that, you better know about the revaluation of assets and liabilities now and then, along with impairment and handling that. 6th block. 7th is all about change of methods of depreciation. Okay. These are the 7 aspects are going to be covered in our depreciation chapter. Changes of method of depreciation is nothing but you might have followed some of the methods here, probably straight line method or WDV method. 2 predominant methods we have: straight line method and written down value method of depreciation. Beyond that, we have still some other methods also. Of course, currently we depend on only these 2 methods. Since for 4 or 5 years we may follow SLM method, suddenly we thought to change from SLM to WDV. That will be called as 7th one, method of changing the method of depreciation. You may follow SLM method. You now decided to shift yourself from SLM method to WDV method. Can I shift that? Yeah, of course you can do. The life of the assets may be 10 years. For 3 to 4 years, I might have depreciated using the SLM method. 3 years later, from 4th year onwards, I may suppose to change from the SLM to WDV method. That also be applicable. This changing of the method may be retrospective or prospective. 2 ways are there. We'll study that later on. And when it is all about accounting, we have predominantly 2 methods of accounting. One is direct adjustment of the depreciation loss in the P&L account. Another one is create the provision and the depreciation loss is adjusted in the provisions account. So provision for depreciation. These 2 models. On sale of asset, that will also be treated in 2 ways. Okay, sale of asset. One is the sale may be adjusted or routed through the asset account. Another one is that sale may be routed through asset disposal account. Okay. So we have to cover up these 7 points in our chapter depreciation and amortization. Meaning of depreciation. Why do I feel there is a value loss? That will be coming under reasons for depreciation. What is the importance of considering the depreciation part in our accounting? 3rd block. These are the theory. How can we calculate the amount of depreciation every year to be charged to the P&L account? Where it comes under method of depreciation. So we have 2 predominant methods, SLM method and WDV method. After calculating the depreciation amount will be debited to the P&L account, or anyhow it is going to be accounted. That will be the 5th adjustment. And even after the depreciation is only assumed rough calculation basis, may not reflect proper value when you compare with the market. Okay, 1 lakh rupees, the depreciation may be 20. From the 1 lakh, I reduced to 20,000 rupees. Today, the value may be 80. But if I go and verify what is today's worth in the market, it may not be 80. It may be more than 80 or less than 80. That's called revaluation. So how can we handle that revaluation scenario will be studied in the 6th step. And last step, I could have followed one of the methods since very long ago, so we thought to change that method from one to the other, SLM to WDV method or other way. So that will come under the seventh steps. Almost 7 blocks we are going to study here. Clear? So asset predominantly here we call this being PPE, property, plant and equipment. Property, plant, equipment. So traditionally we might have called fixed assets, building, plant and machinery, furniture and fixtures. Like currently we have a common term called PPE, property, plant, equipment. Now you could have purchased a property, plant, equipment for rupees 100,000, and you use that asset for one full year. Because of the usage, the value of the assets will go down, right? Probably by the first year end, you lost 30,000 rupees worth value of the asset. Hereafter, the value of the asset being 70. This will be called opening value of the assets. This will be called written down value of the assets. The value lost due to the usage, this is called depreciation. Clear? So you purchase a bike for rupees 1 lakh. After 1 year's usage, the bike value may be 70 or 80,000 rupees. You purchase probably a mobile, 1 year later the value will go down. Due to the usage, the value loss for any asset is named as depreciation. So depreciation is nothing but value loss. Value loss. Is that clear? So depreciation. Loss in value of the property, plant, equipment is called depreciation. Clear? And that too, this depreciation like a loss or expenses, but involves no cash outflow. No cash outflow. So that's why it is called non-cash item. Non-cash item. Always remember, if you spend 100 rupees for or 10,000 rupees for rent payment, automatically what happens? Your cash balance will reduce by 10,000 rupees. You have to pay the rent. If you are paying for electricity, cash will go off. But 1 lakh worth rupees, 1 lakh worth asset, 1 year after the value becomes only 70. Value reduces from 1 lakh to 70. That 30,000 rupees loss is considered as the expenses named as depreciation. Involves no cash outflow. Involves no cash outflow. You purchased a TV costing rupees 50,000 rupees for your home needs. Okay, you purchased the TV. You installed 1 year later, because of the usage, if you want to discard that TV, it costs us only 40,000 rupees or 35,000 rupees. Because anyhow, it's a second hand used one, the value will go down. Because of your enjoyment, the value has gone down. So the value loss is named as depreciation. Okay, apart from that, after purchasing the TV, some other additional cost is also there. What are they? Electricity bill increases, any cable or net connection will also be required. For that also you spend money. So that cost is around rupees 1,000 per month. So after purchasing the TV, what is the expenses you are facing? 50,000 rupees worth for TV. 1 year later becomes 35,000 rupees. So the value reduction is 15,000 named as depreciation. This is called depreciation. Apart from that, for watching the TV, of course, you need to connect with the electricity and some net or cable services, whatever it may be. For that, roughly you spend around 1,000 rupees per month. For 12 months, you spend 12,000 rupees. So for enjoying the TV, okay, what are the amount you are going to spend? So out of your pocket, you pay around 12,000 rupees for the monthly rent and other thing. And already you purchased, the value has lost from 50 to 35. So the loss of value being 15,000. The overall expenses for enjoying this TV per year is 27,000. Out of the 27,000 rupees, cash goes out of your pocket is only 12,000 in this year. This 15,000 was already spent. While purchasing the TV, might have spent already. Today the TV's value has gone down. So in balance sheet, you write the value of the TV being 50 to subtract the value loss named as depreciation from that 15. Then you write this being 35,000 rupees. In your balance sheet, what do you do? Property, plant, equipment. Earlier 50, now subtract 15. So closing value is 35. Similarly, in your P&L account, what happens? Depreciation, you write the value being 15,000 rupees. 15,000 rupees. Right. In case of cash, you may have 40,000 rupees cash. Because of the TV, you could have spent 12,000 rupees. Then the cash balance decreases to 28. Here you write this as expenses related to rental and all. So one is non-cash item, another one is cash item. Another one is cash item. Always remember, depreciation is also loss or expenses only, but it reduces the assets value, not will have any impact in the cash balance. Okay. Now, nature. It is a non-cash expenses. It is a non-cash expenses. And depreciation is otherwise named as allocation of the depreciable amount of PP over the estimated life. That's a very, very important point you have to understand. It's an allocation. Allocation. Is that clear? You purchased an asset. So, for example, you purchased a bike for rupees 100,000 rupees, and you know that it will be useful for at most 5 years. Okay, after 5 years, it becomes a scrap. You can sell it for only 10,000 rupees. So this is the original value, and you estimate the amount you can recover after 5 years of usage being 10,000 rupees. That 10,000 rupees is called scrap value. Now, how many years you can use a two-wheeler? We assume it may be 4 years or 5 years, depending upon the nature of the bike and the usage also. We assume that the life of the asset being 5 years. 5 years. Is that clear? Now, this the difference between original value and scrap value. I purchased it for 1 lakh, and 5 years after usage, it becomes only 10,000 rupees. So, from this, it is very clear the value of the assets 1 lakh becomes 10,000 because of the usage over 5 years period, or the value loss being 90,000 rupees over 5 years. It means every year how much you are losing? 90,000 divided by 5. 18,000 rupees you are losing every year. Is that clear? The loss being 18,000 rupees. Okay, if I purchase a bike for the first year, the cost being 18,000, second year cost being 18,000, third year cost being 18,000, all these things are called depreciation year after year. Apart from that, petrol, repair and all other expenses also be possible, and those things are in the form of cash. This 18,000 is non-cash, and other expenses may be cash expenses. Whatever the assets you purchase, you know, at the time of purchase, lump sum payment will be there, but you will not consider that being the expenses. Only to the extent value lost due to the usage is considered as an expenses. You understand? I purchased stationery for rupees 1,000. Year end, I found that the stationery balance being 200. What does it mean? 1,000 becomes 200. 800 rupees worth of stationery is now missing. Means you could have consumed, then it will be assumed to be expenses. Clear? So, 1,000 rupees worth of stationery purchased, and the year end stock being 200. And what about the 800? 800 rupees is missing, means might have been consumed. This is called expenses. What about the remaining 200? May be consumed the next year, then it is the expenses for the next year. Whatever the payment you spend, okay, for that the benefit is enjoyed, then that payment is expenses. Any payment you made, but the benefit still pending to be enjoyable later, then that value is considered as an asset. If the bike is purchased for 1 lakh rupees, you will not enjoy the entire benefit in 1 year. You can enjoy the benefit over how many years? 5 years. Even after the enjoyment, the value of the asset becomes 10,000 rupees by the end of fifth year. Small scrap value is there. So the difference between these two, 90,000 rupees lost, not 1 year. It's lost in 5 years. So what happened? You paid 1 lakh rupees in your balance sheet. This will appear this way. Original value of the asset being 1 lakh, and profit and loss in the very first year. First year you used it, right? So 90,000 divided by 5, 18,000 rupees you lost its value, named as depreciation. To the extent of amount paid becomes useless hereafter, or you enjoy it today, that value will be debited to the P&L account as depreciation. First year over. Okay. Then the balance be 82,000 rupees. When you go for the second year, 82,000 rupees worth two-wheeler is again used. For the next year, again we use no, because of that usage, another 18,000 rupees is lost. This is for the second year. Okay. And this will be the depreciation for the second year. This is year 1, this is year 2. It means the entire cost we lose because of the usage of the assets over the lifespan is allocated over the period. 90,000 you lose over the 5 years, and very first year 18,000 rupees, second year 18,000 rupees, third year 18,000 rupees. That's how You consider the amount you paid for the asset being the expenses for every year for 5 years. Every year for 5 years. That is other way can be that 90,000 is allocated over the 5 years period. Allocated to the 5 years period. Is that clear? That's why it is named as allocation of depreciable amount. What is called depreciable amount? This 90,000 is called depreciable amount. How much of the value is going to be depreciated over the years due to the usage is called depreciable amount. This 90,000 is depreciable over the 5 years period. And every year it is 18,000 rupees debited to the P&L account. That process is called allocation. Clear? So, as I completed this one with this, meaning is over. So, what is called depreciation? Depreciation is nothing but value loss of any assets due to the usage, number one. Number two, the depreciable amount, original value minus scrap, will be enjoyable over 4 or 5 years, means that entire value is allocated as expenses for the 4 or 5 years. That's why it's called allocation of expenses. Because of the depreciation, if I ask you a question, cash is going out or not? So you say simply, no, cash is not going out. Because it is reducing the value of the assets in your balance sheet, the value of the asset is subtracted. It will not have any cash outflow. So that's why it is called non-cash item. Then you need to understand the difference between depreciation and depreciable amount. Depreciable amount is the difference between original value minus scrap value. 1 lakh over the life period, if you use the value becomes 10,000 rupees, then how much you are losing? Almost 90,000 rupees you are losing. You know, that is called depreciable amount. Hope the first slide is over. Any doubts here with respect to the first slide? Now, next we'll move on to the next content. Reason. Okay. Why the value is decreasing? You purchased a two-wheeler. 1 year later, the value will definitely go down. Is that okay? Now the question is, why the value is decreasing? Why the value is decreasing? Huh? Because of usage. Okay. I keep it pending without usage. What about in this situation? I purchase a two-wheeler. Okay. The moment I purchase is keep it safe without even single day use, because I got some job outside India. I left India. Okay. After 1 year, I came to India. I come to India and see whether the bike is in good state or not. Yes, of course, the bike is in good state. Now the question is, will the asset lose its value or not? I am not used at all. Still, value is lost. So, from this, it is very clear the value of the assets is lost not only due to the usage. Sometimes it may be due to the passage of time. Okay. I paid 5 lakhs rupees and I got the rights to use the property for 5 years. Contract. 5 lakhs I paid and I have the contract for using it for 5 years. Lease like. I didn't use for 2 years. Then immediately I am losing the money. You do a top up, mobile top up or whatever it may be, by paying say 1 year's top up, by paying say per month 1,000 for 12 months, 12,000. You are not used a single day. What happens to the value 12,000? Becomes zero. Some assets will have the life based on the time, whether you use it or not, the value will go down. So there may be some reasons the value of the assets may go down. One is usage. Sometimes it may be whether used or not will go down. Clear? Let's see all the reasons here, one after one. One is all about physical wear and tear. Any fixed assets you have, if you start use, definitely there will be wear and tear. Okay. As there is wear and tear, the value will definitely go down. If you purchase a gold chain for a sovereign, probably 8 grams, sometimes later, if you cross verify that the value may be 7.5 sovereign, like because of the usage, it will go lose its own value. This is called wear and tear, physical wear and tear. Okay. So the moment you purchase a bike, all the components may be fresh and completely in good condition. Sometimes later, all these things may be having some loose contact and loose because of wear and tear. Because of that reason, the value of the asset will go down. Is called physical wear and tear. Second one is all about effluxion of time. Effluxion of time, otherwise passage of time. I paid 1 lakh for getting a license. Okay, He gave me the license to use it for 5 years. Fifth year end, I go and argue with him, sir, I have not used even single day, sir. Kindly return. No, no chance. I have given 5 years rights, whether you use it or not, your money will be spent. This is called a fluxion of time, passage of time. And sometimes it may be outdated, obsolescence. Obsolescence, otherwise named as outdated. Okay, all the things are working properly. I purchased a mobile, 2G mobile. Okay, very long ago. It was my first costly mobile purchased. Okay, it cost us around 27,500 by the time. 27,500 by the time. Probably in 2011, I think so. 2010 and 11 itself. All the facilities what you have now, the net and all browsing, I too had in that mobile in 2010. Okay, how many of you heard about this brand? I don't know. HTC. How many of you heard about this company? HTC. So you heard about that. It was very famous mobile by the time. Blueberry was still famous earlier to that. So HTC is one of the famous brands. So I purchased by paying 27,500. It's a premium model. Okay, the 1 year later 3G introduced. This is 2G. That's all. This mobile becomes obsolete. Obsolete means, of course, it will work. It will work, but I'm in need of 3G. Modern technology. Technology change made me irredundant with that old one. Okay. So I thought to exchange that mobile. Okay. The picture quality today, Samsung and other Vivo like and Oppo, very familiar to give more resolution also. Pixel is higher, right? So you get quality pictures if you take selfie or group photo, whatever it may be, using the latest mobile. That time I had such a quality in HTC mobile, 27,500. So quality camera. So I want to shift from 2G to 3G. So went to the shop and I wanted to exchange. They asked me for 500 rupees. I told him even that the memory card and the camera, superb one. What about the price for that? Sir, we pay 500 only for that reason. Otherwise, this mobile is nothing required hereafter. So, see, the mobile working for 2G is not fit for today. We are in 5G mode. So, automatically what happens? The mobile is good condition but not required. Okay? Not required. You understand? So, this is called outdated. Outdated. Outdated is called obsolescence. The assets value lost due to the outdated. Today, that technology is not required. Right. Value lost by change in technology or taste or fashion. All these things are falling under obsolescence. One is wear and tear. Second one is efflection of time, passage of time. Third one is obsolescence. Obsolescence is nothing but outdated, late. Okay. Now, fourth one is depletion. Depletion is nothing but if you start consuming, the quantity what you have will decrease, is called depletion. If you are consuming, the quantity will go down. Okay, you have a sack of rice, start eat every day. What happens? Sometimes later, the sack of rice will go down, zero. Okay, so you have some quantity, start consuming, then it will get over. That is called depletion. There's a quantity, if you are consuming, then it will go down. Usually this will be suitable for mining industry. It will be suitable for mining industry. Is that clear? Okay. Mining industry. See, government gives the license to extract any minerals available. If government finds some places, okay. So here you think you will be getting coal and copper and all. Immediately they will give the license to extract all those things. They will go for a scientific review to find out how much of quantity of coal will be available. They estimate here it will be around 1 lakh ton may be available, and they will fix you have to pay me 1 crore rupees. 1 crore rupees. Is that okay? So for every ton you extract, what happens? 100 rupees you have to pay. This year you have not extracted, you no need to pay. This year you extracted full 1 lakh ton, you have to pay completely. You understand? Because of the extraction, the quantity available in that mine will be decreasing. Based on that, this 1 crore cost will be amortized over the period. Amortized over the period. Okay. So 1 lakh ton, okay, rupees 100 lakhs. So naturally what happens? 100 rupees per unit, you have to consider this being the value loss. If you extract 1 ton, 100 rupees loss. If you extract 2 ton, 200 rupees is lost. That's how you can calculate the depreciation. which is called depletion, physical deterioration of natural resources. Natural resources like ore deposits in mines and oil wells. Mines and oil wells. So depletion method is suitable for the natural resources availability. Is that clear? And amortization. Amortization. Okay. The value loss of intangible assets. The value loss of intangible assets. We may have some tangible and intangible assets like and furniture, table, bureau, and probably land, machines. All these things are tangible assets. I do some research. After that, I find some technical know-how. I registered and got a patent. That patent has 5 crore rupees worth, but I cannot show you because it's an intangible asset. It's a patent, technical know-how, some blueprint I have. All these things are intangible form. It has no physical substance. That will also lose its value. What happens in the case of COVID time? During the COVID time, co-vaccines were very expensive because just then was invented and got the royalty. Huge price was fixed sometime. But today, what happens? No one started using this, so now becomes lethargy. Like they might have spent huge money. That entire amount will be just due to the research and development. They spend huge money for R&D purpose. Okay, that R&D, after R&D, they got the patent right. So the patent value is equal to the R&D cost. But you cannot see the patent. They can use that patent for manufacturing subsequently with their brand name. They sell and collect the money. Any of the patent value at the time of COVID is now slowly decreasing. Today, it's very lesser value, right? Similarly, the intangible value of the assets also lose its value. That loss of value of intangible assets is named as amortization. So, amortization, not depreciation. Is that clear? Value loss of intangible assets. Sixth one is all about dilapidation. Dilapidation. Okay. Dilapidation is nothing but old house. Okay. The building, old buildings. Okay. Today you can use it for the scarer movie, thriller movie or scarer movie, right? So in those ghost movie, they will use for cinema making and all. So deterioration due to old age, especially old building. It's not suitable for living anymore. At any time, it may damage and the floor may be weak or roof may fall at any time on your head and all endangers your life. So those things are called dilapidated. Due to that, the value may be losing dilapidation. And seventh one is changes in economic environment. Changes in economic environment. Changes in economic environment is nothing but okay. The asset is still capable of working, but we are grown up. We are better financially, so that we'll move on to the next one. So when we are very middle class level, we may purchase a two-wheeler. Sometimes later we go for four-wheeler. We shifted ourselves from two-wheeler to four-wheeler. Still we have the two-wheeler kept idly. Okay, why don't we use? We become richer and we become above average people. We are capable of using this. Economically, we are now superior to use this one. Of course, this two-wheeler is still usable, but I don't want to use it because of economic environment, change in economic environment. So we still have expiration of legal rights. Expiration of legal right is similar to the second one. I may get some legal right for extraction or usage of the assets. I paid 1 lakh and get the right to use for 3 years. Whether you use it or not, in matter of 3 years, that entire 1 lakh will be lost. Okay. So due to the expiration of the legal rights, so you are losing the value of the assets, which is the one more reason for the depreciation. So you have to understand causes and depreciation. Causes of depreciation or reasons of depreciation. One is physical wear and tear. Second one is effluxion of time. Third one is obsolescence. Fourth, depletion. Fifth, amortization. Sixth, dilapidation. Seventh, change in economic environment. Last one is expiration of legal rights. So these things may be expected in theory, 2 marks or 3 marks, like you can expect. Is that clear? Hope now you'll be able to understand the second part also. So we have completed 2 aspects. One is meaning. Depreciation is nothing but value loss. Value of the loss of the assets. Okay. Next, if I ask you a question, why the assets value is lost? We have the reasons. Physical wear and tear, obsolescence, and maybe effluxion of time, obsolescence, and dilapidation, depletion, and all these are the reasons for the depreciation. Clear? Now, we have to move on to the third point before we go for calculating the method of depreciation. The third point is all about objectives of depreciation. Objectives of depreciation. Clear? Now, now, understand that we manufacture a table. For manufacturing the table, we are in need of wood, rupees 5,000. We are in need of a carpenter who charges around 3,000 rupees per table, and we are in need of a machine. We purchase the machine, the value of the machine being 1 lakh. Now, finally sold for rupees 10,000. Come on, tell me. Number one, what is the cost of production? Cost of production of table. Second one is find out the profit. Third one is what about the value of the machine? Machine cost. Is that okay? Clear? If I ask you the three questions from this given detail, unless you understand the depreciation, you cannot get the answer properly. Come on, tell me. What is the cost of manufacturing the table? Huh? What is the cost of the manufacturing table? Wood 5,000, without which we cannot manufacture. And of course, we need to pay the fee for carpenter 3,000. And we need to use a machine also. We need to use the machine also. Machine rupees 1 lakh. Machine rupees 1 lakh. Now tell me whether the machine is expenses or not expenses. Huh? You cannot say the machine being the expenses. Machine has long life, can be used multiple times, not for only one table. Now you have to find out how many tables can be used or manufactured using the machine. There's a specification. You can manufacture 100 tables using a machine. So from this it is very clear. 1 lakh rupees you spend for manufacturing 100 table means every table requires 100th machine's life. Otherwise 1,000 rupees is the value lost due to the usage of machine for the manufacturing the table. You understand? So using the machine you can manufacture 100 tables. I purchase the machine for your requirement. While billing you will tell me, sir, wood cost 5,000, carpenter cost 3,000. Okay, what about the machine cost? Naturally I cannot add the entire 1 lakh from to your cost. I cannot leave unaccounted. Anyhow I have to account. To the extent of value loss of that machine due to manufacturing the table is called depreciation, meant for this cost of the table. Is that okay? 1,000 rupees you are losing for every table you manufacture. Earlier you have machine being 1 lakh. Now you have manufactured one table. Because of manufacturing one table, you now reduce the value of the loss, value of the asset by 1,000. Hereafter the value of the asset being 99,000. 99,000. Is that clear? So what about that 1,000 rupees value loss? That becomes the expenses. Then what is your expenses? 5,000, 3,000, 1,000, 9,000 will be your expenses. This is called cost of production. You understand? So unless you know this information, you cannot find out the cost of production. Cost of production. And cost of production is 9,000. The sale price is 10,000. You produced at the cost of rupees 9,000. The sale price is 10,000. The difference between these two is your profit. So you can find out the profit also only when you know the depreciation. If you are not aware about the depreciation, of course you cannot calculate. So you need to know depreciation properly. Unless you know the depreciation, you cannot calculate. To the extent of value loss of the assets because of manufacturing the table will be forming part of the assets value. By the year end, the value of the assets will be decreased to that extent of lost value. Is that clear? Now, if you could have manufactured around 90 tables, what happens? Machine value being 1 lakh. For manufacturing every one table, the value of the machine lost by 1,000 rupees naturally. Is that okay? This is what about the value loss per table manufactured. Currently, I have manufactured 90 tables. Per table costs me 1000 rupees value loss for the asset. 90,000 lost. Now we have the assets value being only 10,000. So the machine purchased at 1 lakh. Today the value of the machine is only 90. What does it mean? The machine is almost almost reaches its time for the replacement. It's going to be lost. Hereafter we have to get ready for replacing new asset. So 4 points I have discussed. One is all about correct income measurement. Unless you know this, you cannot find out this profit properly. Second one is true possession statement. Because of the depreciation, adjusted value of the fixed assets. This value can be calculated. This is the true value of the asset by the year end. By the year end, what is the value of the assets, sir? Is it 1 lakh? No, sir. At the time of purchasing, it was 1 lakh. Today, it's not 1 lakh because of the usage. 1,000 has been reduced. Hereafter, it's only 99,000. Unless you show the value of the assets being 99,000, the financial position is not true one. It's a wrong one only. Third point is all about funds for replacement. So when you come to know that originally purchased for 1 lakh, today's value is only 10,000, means so much of value were already lost. It's supposed to be time to replace. So we have to get ready for fund for replacing the asset. So we'll be double cautious here. So this is the third point. And fourth point, ascertainment of true cost of production. This one, 9,000 rupees. This true cost of production can also be calculated only when we know the depreciation. These are the 4 points. Because of the reason only, calculation of depreciation most important. Is that clear? So I have completed the theory part. Now, few more theory before we go for calculating the practical problems here. One is all about depreciable asset. What is called depreciable asset? Okay. You make a payment for purchasing a machine for rupees 1 lakh. For rupees 1 lakh. Okay. And this machine will have a life for more than 1 year. Okay. Life more than 1 year. Then it is automatically becomes asset. Clear? More than 1 year. Can I say the life being infinity? No. In case of infinity, this will not work. In case of an asset being the land, what about the life of the land? In case of land and building, building will work for 20 or 25 years depending upon the construction pattern. Land remains useful for a long period, maybe infinite period. So if the period being infinite, we definitely will not bother about depreciation. Should have life more than 1 year, but limited life. Then definitely depreciation will be there. So that asset is called depreciable assets. This is depreciable assets. This is not so. And this machine is used. This machine is used by the entity. Probably if the entity being XYZ, the entity can use this machine for production of any goods or rendering service. Okay, rendering service. We purchase the AC and TV, laptop. All these assets is to render the coaching services, right? So then the TV, AC, and whatever the equipments, electronic gadgets we have are called machines and depreciable assets because the value will be lost. Or I may buy and give it for rental purpose to make the money. In that case also it will be my asset only. Or I may use the asset for official purpose for my office to make the work easier or sales to make the sales easier. So held by an enterprises for use in production and supply of goods and services. So production as well as rendering services. Or I can rent it out to third party and make the money, or it may be used for the office purposes, and for the office computer what we have is also asset for us because it is going to be supportive purpose, right? Not for the purpose of sale. I don't have the intention to sell. Do I sell the TV, AC and laptop what I have? Definitely it's not my intention to sell. But laptop vendor, he purchases and sells the laptops for him, it's stock. For me, these things are not my stock. So you will now understand what is called depreciable assets. Any payment gives you benefit for more than 1 year, but the life is limited, not being infinite. Okay, these two are my assets. Apart from that, this asset is held for what? Any production of commodity or rendering services or for my office use or some other sales use, or I may use it for renting purpose, but it is not going to be sold for making profit. My intention is not to sell and make the profit. This is called depreciable assets. So what is called depreciable asset means these are the key ingredients you have to keep in your mind. Next, in case of depreciation, factors affecting the amount of depreciation. So before that, we'll straight away go for one of the methods. So methods of depreciation, we have straight line method of depreciation. Another one is written down value of depreciation. Straight line method of depreciation and written down value of depreciation. Is that clear? Now, question number 1. Calculate the amount of depreciation and rate of depreciation. Two items are going to be calculated under straight line method. Written down value method, sum of the years digits method, we'll deal it later on. So first let me finish off under straight line method of depreciation. Okay, number 1, amount of depreciation. Amount of depreciation. Amount of depreciation. So what method I'm going to use? Straight line method. Straight line method of depreciation or fixed installment method. That's how it may be named. Fixed installment method. Depreciation on original value method. That's how it may be answered. The original value, whatever it may be, on that you have to calculate the depreciation. Clear? Now, let's see. Amount of depreciation is equal to original value minus scrap value divided by life. N represents life. So, I use D for amount of depreciation. For the life, it may be N like and original value and scrap. In this illustration, the original value of the asset being 65,000, scrap value of the assets at the end of the life being 5,000 rupees, and we expected that this machine will work for 4 years. Then amount of depreciation in this case being 65,000 original value minus scrap value 5,000, and number of years this asset will work for is 4 years. So 65 minus 5, 60,000 is going to be lost over the 4 years period. It means you are losing 15,000 rupees per year. This 15,000 is called amount of depreciation per year. Is that clear? Now, first question is answered. The second question is all about rate of depreciation. Rate of depreciation. Rate of depreciation, usually I use small d. Small d represents rate of depreciation. Capital D represents amount of depreciation. Under SLM method, the rate of depreciation being very simple. Amount of depreciation or capital D, okay, or capital D divided by original value of the asset in percentage. Amount of depreciation being 15,000 and original value of the asset being 65,000 rupees. Come on, tell me the rate of depreciation here. Make it faster. %23.08%. Clear? So what we have calculated here is all about for SLM method, straight line method of depreciation. Now we have to find out what is the WDV, written down value of the asset every year after this depreciation. Let's see. Now, original value of the asset being 65,000 at 0th period. Okay. Minus depreciation for the first year, year 1. Out of 65,000 rupees, 23.08% is lost. Come on, find out that. You have to find out at this rate, at the rate of 23.08 percentage. If you find out 3.08 percentage, you will be getting 15,000. Am I right? This 15,000, we have already found out that the same number you will get. So 15,000. After subtracting the depreciation number 1, the value what you get here is all about 50,000 rupees, named as WDV. This is called WDV, written down value by the end of first year. Original value after depreciation, the value what you arrive now, that is called written down value. I purchased the asset for 65,000 rupees. After 1 year's usage, that 65,000 value becomes 50,000 rupees. I lost 15,000 rupees. That 15,000 is expenses debit to P&L account. Hereafter, the value of the asset appears in the balance sheet is only 50,000 rupees. Because of the value reduction 15,000, there is no any cash outflow. There is no any cash outflow. That's why it is called non-cash expenses. Next, we'll go for the depreciation number 2. Depreciation number 2, second year. Again, calculate original value method or straight line method. You have to apply the same 23.08 on this original value. So for the second year also, you are going to calculate the amount of depreciation at the rate of 23.08 percentage on the original value. So 65,000 into 23.08, you'll get the, of course, same value here, 15,000 rupees. Then this value becomes 35,000. This is WDV by the end of second year minus depreciation for the third year. Again, you have to calculate from the original value 65,000. For the 65,000, the same way you have to calculate the rate of 23.08. You'll get 15,000. You'll get 15,000. After that, the value what you get here is 20,000 rupees, which is called WDV by the end of third year. Third year value. The balance sheet shows the value of the assets as 20,000 rupees by the end of third year. And we'll move on to the fourth year. So depreciation for the fourth year. Again, calculate the same 23.08 rate on the original value of 65,000. You will get the depreciation being the same 15,000. Hereafter, the WD value by the end of fourth year being 5,000 rupees. It has no more further life. That's all. Now it becomes scrap, non-usable. As it becomes scrap, you have to discard that in the market. If you go and sell in the market, you found that the sale value being 10,000 by the end of fourth year. This 5,000 rupees, what we expected is nothing but scrap value calculated or estimated. It's not correct one. On original sale time only, we are able to find out what is the real money. It may be not matching. Usually not matching. It may be higher or lesser. If the sale value is higher, this is called as profit on sale. If the sale value is lesser, then it will be named as loss on sale. So now, fourth year, after 4 years of usage, the value of the asset becomes asset realized to me 10,000 rupees sale value. So what happens? I get 5,000 rupees excess. Then this 5,000 is called profit on sale. Clear? This is called straight line method. So when you want to calculate any amount of depreciation, you understand what method is that. Second, you have to understand how to calculate amount of depreciation, how to calculate third one, rate of depreciation 3. And then you can calculate what is the depreciable amount or the WDV year after year. Finally, after the usage, if you sell, any profit or loss is there. So 4 items you have to keep in your mind. What sort of method of depreciation you are going to follow? Amount of depreciation, rate of depreciation, WD value after every years of usage, and finally the scrap is sold now. While selling the scrap, do you get any profits or losses? So method of depreciation, one method is completed. One method is completed. Now we have to pass the journal entry also. That is called accounting of journal entry, accounting of depreciation. We will finish up this one first of all, so that we'll go for the accounting later. Come on, make a note of it. So in case of WDV method, you have to follow this formula. Rate of depreciation is equal to 1 minus nth root of scrap value by original value. In this illustration, the scrap value is 5,000. Original value is 65,000 and life being 4 years. I substitute these values here. After calculating this value, you get rate of depreciation being 47.34%. Applying this, I can find out easily the WDV for every year under WDV model. Here, out of 65,000 for the first year at the rate of 47.34%, you get this much depreciation. After depreciation, the value what you get is called WDV. The WDV method of depreciation is nothing but calculating the depreciation based on this value. Based on this value. Is that clear? Similarly, every year, whatever the WDV you have on that, you have to calculate depreciation at the rate of 47.34%. Carry on up to the fourth year, it becomes 5,000. The sale value is 10,000, so you get a profit of rupees 5,000. Clear? Now let's see. Before I go for the another method, sum of the years digits method. Sum of the years digits method is equivalent to WDV method, but a shortcut. In practical life, if you want to calculate the WDV method without any modern gadgets or calculator, it's really tough. So in order to find out the value almost closer or similar to the WDV method, we have one more method called sum of the years digits method. Under this method, the depreciable amount is shared over the 4 years using the years still available for the remaining period, that method. For example, year 1, 2, 3, 4. Now, depreciation under sum of the years digits method. For the first year, you have to do summation of the years. The summation of the 4 years being 10. And in the very first year, you have to find out the depreciation, amount of depreciation is equal to depreciable amount into the year left still, or remaining life of the year, remaining life, divided by sum of the years digits. This is the formula. The depreciable amount is nothing but the difference between these two, which is 60,000. This is the depreciable amount. For the very first year, 60,000 into the years remaining for the first year is 4. 1 year usage after the remaining life being 3. 3 years after the remaining life being 2. 4th year you have the remaining life being only 1. So remaining life in the very first year being 4 divided by sum of the years digits, which is 10. So 60,000 into 4 by 10, 24,000 is the amount of depreciation in the very beginning. Second year 60,000, and at the beginning of second year the remaining life being 3, so 3 by 10. And here 60, the remaining life being 2, 2 in divided by 10. Last 60,000 into 1 by 10. So the amount of depreciation for the second year being 18,000, third year being 12,000, fourth year being 6,000. The sum of the years digits method is resembles like WDV method, right, because in the very beginning higher depreciation, later on lower depreciation. Higher depreciation in the beginning with the lower repairs will have equivalent expenses similar to the expenses we incur in the fourth year, where the depreciation is higher, lower, and repair cost is higher. So of course rest will be the as usual one. So 24, 18, 12. So in case of sum of the years digits method, original value being 65,000, depreciation for the first year being 24,000. We have found out that here, the 4 years depreciation. Okay. So after this, you get how much? 41,000. Second year depreciation being 18,000. We have already calculated. We don't calculate the rate of depreciation here. Very simple. 23,000. Third year 12,000 is subtracted from here. You get 11,000 rupees. Fourth year you subtract another 6,000 rupees. Then finally you get 5,000 rupees. Yeah. After the fourth year, it is not useful hereafter to use, so you want to discard it. If you go and sell, the market price may be either higher or lesser. Most probably it may not be matching. If it is higher, then it is called profit on sale. Profit on sale. Hope now you'll be able to understand this one. Clear? Clear? Now, let's see WDV method. Under WDV method, rate of depreciation is equal to 1 minus nth root of scrap value by original value, isn't it? How do I get this one? How do I get this one? Let's see. Right? This is the timeline. I purchase the asset at 0th period. Every year I depreciate, and nth period it becomes scrap value. The value we depreciated every period will be called as rate of depreciation, small p. In the very first year, okay, means scrap value or WD value by the end of first year. Scrap value or WD value by the end of first year is nothing but original value minus depreciation, amount of depreciation. The amount of depreciation is nothing but original value into rate of depreciation. So what we have done here, I'll put that value here. This is the original value. From the original value, I have to subtract this depreciation. This value is calculated this way, original value into rate of depreciation. Okay, so OV minus OV into D. OV represents original value minus amount of depreciation. That amount of depreciation is calculated this way, original value into rate of depreciation. We can simplify this one where OV remains constant in both the side. I take the OV out, then 1 minus D. OV into 1 minus D is a simplified version. Is that okay? OV is common, I can take it out. So then the new formula being OV into 1 minus D. If I multiply the OV, original value, inside the value brackets, OV into 1, it's OV. OV into D, OV dot D, or OV into D, so we get the same. Scrap value by the end of second year is equal to, we start with this value. This is nothing but what? OV into 1 minus D. Okay, isn't it? This 34,229 is nothing but OV into 1 minus D. That's the value. From that OV, that value OV into 1 minus D, you have to subtract the depreciation for the next year. Depreciation for the second year is nothing but, on this value you are going to use the rate of depreciation. This one is named as what? OV into 1 minus D. This is the value. On this I am going to apply the rate of depreciation. On that I am going to apply the rate of depreciation. Here OV 1 minus D is common. I can take that OV 1 minus D outside. If I take this outside, you divide this by this, you will get 1. You divide this by OV 1 minus D, you will get D minus D. So OV 1 minus D into 1 minus D is the formula. You can simplify this one. So once you simplify, OV into 1 minus D to the power 2 is the answer. So from this it is very clear. Scrap value by the end of first year is equal to OV into 1 minus D. Scrap value by the end of second year, OV into 1 minus D to the power 2. If goes on until n number of years, what could be the answer? This formula remains the same. OV into 1 minus D to the power n. That's all. This is the ultimate formula. If you have this formula, scrap value is equal to OV into 1 minus D to the power D, you can calculate the depreciated value of the asset for any year under WDV method. Now let's see, in this illustration, original value being 65,000, scrap value being 5,000, and your rate of depreciation under WDV model being 47.34. If I ask you what is the WDV value by the end of third year, then you can use the formula WDV or scrap value for any year. Scrap value for any year, third year, is equal to original value into 1 minus D to the power 3 is the formula. Hope so you could understand. Under WDV model, to find out the scrap value for any given year, you can use this formula. Scrap value is equal to, scrap value for any year is equal to original value into 1 minus D to the power that year. 3 years or 4 years, whatever it may be. Let's see. In this illustration, the original value being 65,000 into 1 minus D. D in this case being 47.34, otherwise in decimal 0.4734 to the power 3. To the power 3. Now you can use the non-scientific calculator to arrive this one. 1 minus 0.4734. You got this value. Power 3 means just to press into equal. Just to press into equal, it will be power 2. Again press equal, this is power 3. You can try it also yourself. Okay. Whatever the value you have for the power into equal is equal to the power 2. Again, just press the equal, you'll get power 3 and so on. For 5 years, you have to press equal only, so you'll get the answer easily. Are you getting this answer? Yes or no? Okay. So this value being 0.14603. Okay. 14603 into 14603. If I multiply this with 65,000, then WD value in this case being 9,492. 9,492. So we got that answer only here, 9,492. So under WDV model, to find out the scrap value or WDV value for any year, if I have the assets value being 40 years or life being 40 years, I want to find out the scrap value for the 25th year. How can we calculate? Original value into 1 minus d to the power 25. That's all. That to power 25, you can calculate the way how I taught you using the non-scientific calculator. So power 2 is equal to into equal is the power 2. Then you just press equal only to arrive the required power. Okay. Always test yourself. That's why I always tell you, come with the calculator. Do all these things practicing. Clear? Hope now you'll be able to understand the first formula. This is the formula for what? Arriving scrap value for any given year. Scrap value for any given year is equal to original value into 1 minus d to the power given year. But if I want to calculate the d, how can I calculate the d? Rate of depreciation. D represents the rate of depreciation. How will I calculate the d? Use the same formula, do slight shifting, and you'll get the formula for d. See, scrap value is equal to original value into 1 minus d to the power n. Otherwise, 1 minus d to the power n is equal to, you take the original value the other side, so scrap value divided by original value. 1 minus d to the power n, otherwise 1 minus d is equal to this power n transfer to the other side becomes root n. Nth root of scrap value divided by original value. Is that okay? Now d is equal to you take the one other side. Anyhow, it becomes minus. I change the sign also, so it becomes plus 1 minus root of nth root of scrap value by original value. Hope now you'll be able to understand the derivation of the rate of depreciation under WDV model. So two formulae you have to by heart. That one is to arrive the scrap value for any number of years, any given years under WDV value. Scrap value is equal to original value into 1 minus d to the power n. Or if you want to calculate the rate of depreciation, the formula being 1 minus nth root of scrap value by original value. That's how you can apply these two formulae here. Clear? Yeah, make note of it. Let me brief all the content what we have discussed here with respect to the method of depreciation. Under method of depreciation, we have SLM method, WDV method, sum of the years digits method. So we have three predominant methods. Most probably we are using only SLM and WDV method. Sum of the years digits method is one of the rough crude method. Instead of calculating WDV method has lots of calculations, we can depend on SYDM method. Under SLM method, you have to find out the depreciation. The calculation of depreciation being original value minus scrap value divided by life. This original value minus scrap value, what you get here is that is called depreciable amount. Original value minus scrap value is called depreciable amount. That's how we can calculate the amount of depreciation under SLM method. Second is all about what about the rate of depreciation? Rate of depreciation, I use the small d to represent, right? So here, amount of depreciation, that amount of depreciation is nothing but capital D divided by original value into 100. That's how we'll get the answer. Okay. In case of WDV method, first we have to calculate the rate of depreciation. For the calculation of rate of depreciation, the formula being 1 minus nth root of scrap value divided by original value. Second one is all about to find out the WDV value for any year. Any year. Scrap value for any year. Okay, probably year n. We can find out very easily by this way. Original value into 1 minus d to the power n. That's how we'll get the answer. Is that clear? So two methods. Under sum of the year's digits method, the depreciation being for any year is equal to depreciable amount multiplied with remaining life of the asset in the beginning, remaining life of the asset in the beginning divided by sum of the year's digits. That's how we'll get the depreciation for the every year. If in the case of first year, if the remaining life being 5 years, 5 will be the numerator value, denominator value being summation of the years 5, 4, 3, 2, 1. So 15 will be the denominator value. That's how we'll get the answer here. And between SLM or WDV method, if I ask which method is superior, then naturally SLM method will be least superior and WDV method will be most superior. So you can depend on the second method, and this will be the least choice method. Even for the Income Tax Act, for tax payment and other thing, to calculate the depreciation, we have to depend only on WDV method. In rare scenario only, Income Tax Act recommends to go for SLM method. In most of the cases, we have to depend only on WDV method. Is that clear? That's why we can simply understand the WDV method will be superior than the other method. Now, before I go for making you understand the concept of accounting of depreciation, I ask you to try the calculation of amount of depreciation and rate of depreciation for this illustration. The original value being 1 lakh, scrap value being 20,000 rupees, life being 4 years. Come on, calculate amount of depreciation and rate of depreciation under SLM method, D and D, and calculate rate of depreciation under WD method as well as scrap value by the end of second year. Okay. At the second year end, only these things. Come on, make a note of it and try to get the answer for this. Check your answer. For SLM, D is equal to original value minus scrap value by number of years. 1 lakh minus 20,000 divided by 4 years. Then 20,000 rupees is the amount of depreciation every year. Rate of depreciation is equal to amount of depreciation by original value in percentage. So the value being 20,000 divided by original value here being 1 lakh. In percentage, it is equal to 20%. Is that clear? In case of WDV, rate of depreciation is equal to 1 minus nth root of scrap value by original value. So 1 minus scrap value 20,000 and original value being 1 lakh, life being 4. So then 20,000 divided by 100,000. Fourth root, you have to press the root button twice. This is the root 2, this is the root 2. Okay, then automatically it comes under fourth root, and this is minus, and with that you add plus 1. So the ultimate value being 0.3313 or 33.13%. To find out the scrap value by the end of second year, original value 1 lakh into 1 minus 0.3313 depreciation rate in decimal to the power 2 to get this answer. Okay. So 1 minus root being 0.6687 to the power 2. Okay. 1 minus 0.3313. Okay. 1 minus 0.3313. Okay. Oh my God. 1 minus 0.3313. Yeah. To the power 2 into equal. You'll get this much into 1 lakh. You'll get 44,716. Are you getting this value? Yes. Yeah. Finish up copying this. We'll then move on to the accounting of depreciation first of all. So we have completed methods of depreciation under SLM and WDV method. Currently, we have two predominant methods. And earlier days, in CA Foundation, they had around 12 to 13 methods also. But now you can understand few extra methods more than that not required. Revaluation of assets. See, we have studied two methods, WDV and SLM. There are some other methods like accelerated depreciation, some of the years digits method, sinking fund annuity insurance policy method, depletion method, machine hour rate method, production units method, kilometer method, etc. Revaluation method, repairs provisions method. So these are the other methods also be possible. Almost I have given 11 methods in Singar Academy's text. Of course, for your examination purpose, these two methods are predominant. Other methods you just have the knowledge. That's all. Right. Now, I may go for accounting of depreciation. Accounting of depreciation. In accounting of depreciation, the amount of depreciation directly charged to the P&L account, that method is going to be calculated. Otherwise, we don't open the provision for depreciation. We'll directly debit the depreciation and charge to the P&L account. That's all. That method is going to be solved in this class. Let's see here. Let's see here. For this. Okay. Now, I'm going to pass a journal entry. What is the journal entry for the depreciation? Year 1. First, you purchase the asset. On purchase, the journal entry being 0th period. Asset account debit to bank. Value being 65,000. And now for the year end, first year end, you have to calculate the depreciation. What is the journal entry for the depreciation? Depreciation account debit to asset account. You might have studied this in your final accounts also. The value being 15,000. And then the depreciation being the nominal account transferred to where? P&L accounts debit side. The entry being P&L account debit to depreciation. Value being 15,000. Repeat the same for the second year, third year, and fourth year. I'm going to repeat this for year after year. Is that okay? What about the journal entry for the depreciation for the second year? For that also the same will come. Second year depreciation, third year depreciation, fourth year depreciation. Is that okay? The depreciation what you have calculated finally transferable to the P&L account. That set will be repeated until you close the asset completely. In the last year, you are going to sell the asset. On sale of the asset, you get the money. So bank account debit. How much you are getting? 10,000 rupees. And the value of the asset currently only 5,000 rupees. Every year we have depreciated 15,000. After 4 years depreciation, the value appears in the balance sheet being only 5,000. The value of the asset being 5,000, but we sold for 10,000 rupees, we get 5,000 excess. That excess amount of 5,000 will be named as profit on sale. Profit on sale. Clear? Profit on sale. Apart from that, you need to prepare the concern ledger accounts. Concern ledger accounts. C. I may prepare the ledger accounts also parallelly. Okay. Now, ledger account. Ledger account. Okay. So, I have to prepare asset account, depreciation account, how this will appear in P&L account. Bank account I don't usually prepare because it happens once a while. How this appears in the balance sheet. In the very first year, asset to bank. So, asset to bank, value being 65,000. In the first year end, by depreciation, this value being 15,000. And the depreciation is transferred to P&L account debit side. So, first depreciation to asset, 15,000. Then this 15,000 is transferred to the P&L account. Depreciation is over. In P&L account, depreciation for the first year being 15,000. First year over. On telling the asset, we get a balance of 50,000. We get a balance of 50,000. Balance carried on. This balance becomes asset in the balance sheet. Asset account. Asset account after depreciation appears in the balance sheet being 50,000. This is how first year impact will be there in your final accounts preparation. In the second year, again depreciation to asset, in depreciation to asset, value being 15,000. In asset by depreciation, 15,000. This balance is transferred here. And in P&L account to depreciation, in depreciation by P&L account. As depreciation being the nominal account, after preparation of final accounts, it appears nothing. And P&L account, we have prepared only extract. It will have other income and expenses. I am not sure with all those information, so I just keep it pending. It's a P&L account extract as well as balance sheet extract. On telling this asset, 50,000, 50,000. Now we get 35,000 being the balance. Balance will be transferable to the balance sheet. The asset value shows at 35,000 in the second year. Let's move on to the third year. Again, we'll start with the balance 35,000. In the third year, we have depreciation to asset, the value being 15,000. In asset by depreciation, 15,000. In P&L account to depreciation, 15,000. In depreciation, we have by P&L account. By tallying the depreciation, debit side is equal to credit side, it gets closed. But on tallying the asset account, 35,000, 35,000, get a balance of 20,000 rupees balance. This will go to the balance sheet asset side at rupees 20. By the end of third year, the asset appears at rupees 20. Now let's move on to the last year. Depreciation to asset, depreciation to asset. So in depreciation to asset being 15,000, to asset being 15,000. In asset, I don't have space, so I will continue here. Balance being 20,000. In this asset, by depreciation 15,000. And in P&L account, to depreciation 15,000. In depreciation by P&L account 15,000. Bank not required to be open. In asset by bank 5,000 rupees. And there is a profit. So you are getting 10,000 rupees. You put the value 10,000 here. The profit should be in the other side. 5,000 here. Bank. Profit on sale. Profit on sale. This profit can be transferable to the P&L account. So profit on sale to P&L account, you can pass one more entry this way. This combined entry posting will be this way. The entire amount collection will be posted in the bank. Because of this one, if there is any profit or loss, will be shown separately. In case of profit, it should appear in the debit side of the assets account. In case of loss, it will appear in the credit side. In P&L account credit side, profit on sale is there. Profit on sale. Is that okay? Profit on sale. The value being 5,000 rupees. Finally, if I tally the asset account, we have no balance. No balance. In your balance sheet also, you have no balance for the asset. Depreciation got tallied, eliminated. Okay. This 10,000 may be included in the cash account, but anyhow, I am not going to prepare the cash account. This is the system we follow. Create the depreciation, charge to the P&L account. Year after you repeat. On sale, find out if there is any profit or loss, and for that you pass the journal entry and post that in the ledger. This is called accounting of depreciation in simple sense without provision model. With provision model, we'll continue in the next class, right?